The Eurozone, challenged by structural deficiencies, high unemployment, particularly among the youth, and simmering debt concerns, is facing dismal long-term growth projections. This current economic stagnation underpins the confrontations between European sovereign governments and the European Union. Indeed, this year's Euro challenge isn't simply an economic one. Some increasingly advance the notion that Italy, the fourth largest economy in the EU, and the third largest economy in the Eurozone, might leave the Union. An Ital exit, combined with Brexit, could effectively destroy the dreams of a united Europe.
Unemployed and working class people are losing faith in the system. Protests such as Gilets jaunes in France, Euroscepticism and uncertainty have replaced perseverance and productivity. There's a certain fragility in Europe, and Italy is the country we are most worried about as a potential flashpoint towards yet another European crisis. The stakes are very high, and we are here today to light a clear path out of the darkness. Good morning, my name is Sachin Gulati.
I'm Connor Cerati.
I am Dennis Collins.
I am Garrett Larson.
And I'm William Lee. Italy is burdened with low growth, high debt, and high unemployment. The country's projected deficit for 2019 may be as high as 3% of their GDP, and it continues to pile on debt. We believe that this is distorted and does not reflect the economic potential of this major world economy. We are here today to present economic, financial, and societal changes that are urgently needed to reform Italy and stem the tide of discontent in Europe. A drive towards strategic and effective fiscal policy and structural reform will ignite economic growth for Italy and for the Eurozone.
Let's first look to the Eurozone as a whole. On July 26, 2012, ECB President Mario Draghi stared down a debt crisis and recession with the public promise to protect the euro. Uttering three simple words, whatever it takes, Draghi framed his legacy and launched a roadmap for deepening the economic and monetary union. Last month, Draghi has once again injected monetary drugs into the Eurozone, citing continued weakness and pervasive uncertainty, as he announced cuts to the bank's growth and inflation forecasts. This seems like a familiar pattern, crisis after crisis with no lasting solution.
Let's look at the data. GDP growth in the Eurozone has slowed to its lowest level in 4 years, growing by only 0.2% in the fourth quarter of 2018 compared to Brexit-mired UK growth. Eurozone annual growth for the full year of 2018 came in at 1.8%, failing to reach the European Central Bank's projection of 2%.
Economic growth in the Eurozone, represented in blue, has been comparatively much weaker than that of the United States and China, and the outlook for the European economy has darkened in recent weeks. In early April, the IMF sharply lowered its growth outlook for the Eurozone to just 1.3% growth in 2019, a big cut from 1.6% just 3 months earlier.
Manufacturing is a key area of concern from the Eurozone. February PMI survey data from the IHS market, shown in the chart, depicted that Eurozone manufacturing dropped to a 68-month low of 49.2. March and April readings of 47.5 and 47.8 confirm that the long-term trend is heading towards stagnation. These numbers are below the crucial 50-point level, signaling a contraction in manufacturing activity.
The Eurozone labor market, however, has strung together positive trends. Unemployment in the Eurozone remained unchanged in February at 7.8%, equaling its lowest rate in over 10 years.
Let's now turn our attention to the inflation picture in the Eurozone. In November, Mario Draghi expressed confidence that core inflation will gradually rise thanks to higher wage growth and a recovery in producer import prices. Although oil prices have popped, wages are rising, and employment is high, consumer prices have repeatedly disappointed and underlying inflation remains weak.
Continuing with a review of conditions in the Eurozone, the number of unemployed across the Eurozone dropped to 12.8 million this year. This is over 1 million less than last year's registered rate of 8.5%. Youth unemployment in the Eurozone fell to 16.5% in February, and long-term unemployment fell to 3.5%. This is the lowest level the Eurozone has seen in 10 years.
Over the past 4 years, the ECB has bought 2.6 trillion euros worth of government and corporate bonds in order to stimulate short-term GDP growth and block deflation. Although ECB governors indicated in December that they would officially bring this unprecedented bond buying scheme to a close, it seems like the ECB isn't quite ready to pull the plug on this cheap source of money, launching a new loan program this last month in response to two risks that still clearly tilt to the downside.
Let's turn our attention back to Italy. As you can see by this chart, Italy's economic pain has lasted for almost 25 years. This feeble trend, combined with anger over legal immigration, triggered a populist move to vote for the League and the Five-Star Movement in elections a year ago. The winning parties promised to increase spending, decrease taxes, and reverse pension reform that raised the retirement age.
Italy's National Statistics Institute, ISTAT, reported a 1.1% contraction in GDP in the fourth quarter of 2018, throwing Italy into recession for the third time in a decade. Over the course of 2018, Italy's growth came in at 1%, compared to 1.6% in 2017.
The manufacturing sector is leading the downturn in Italy, with the production of goods declining at its strongest rate since 2013. Companies have been reporting underlying weaknesses for several months now, worried about political tensions, trade wars, and tightening financial conditions. Over the past year, business confidence has dropped from an index of 110.3 to 100.8, those lowest readings since February of 2015. As you can see from this chart, Italian firms are losing faith in business, which correlates to low growth. This graph here shows Italy, the third largest economy in the Eurozone, as part of the World Bank's 2018 Ease of Doing Business report. Italy ranks 46 out of 190 countries covered in terms of its regulatory and entrepreneurial environment.
What about household confidence? Today, Italy has the lowest birth rate in all of Europe. Only 464,000 Italian births were registered in 2017, the lowest number on record. According to Francisco Scalone, a demographer from the University of Bologna, young Italians are increasingly forfeiting children for economic survival. Coupled with an aging population, this declining fertility rate depicted by the chart puts enormous, intractable stress on the Italian pension system and, more importantly, depletes Italy's stock of human capital.
Monetary stimulus and political promises simply haven't worked for the Italian economy. Pressure is on fiscal policymakers and legislators to enact meaningful change and inspire confidence.
This graph illustrates Italy's soaring debt, approaching 2.4 trillion euros. Its ratio of debt to GDP is a stunning 133%. In the final days of 2018, Italy was locked in a contentious battle with the European Commission over the size of the country's deficit. In the final days of 2018, Italy was locked in a contentious battle with the European Commission. Italy's original 2019 budget plan included a deficit equal to 2.4% of the country's GDP, 3 times larger than the plan of the previous government. Ultimately, a deal was struck with the ECB to produce a plan with a deficit of 2.04% of GDP.
But according to Alessandro Massale, a political economist at the State University of Milan, slower than expected growth means that Italy's actual deficit could be as high as 3%. We agree that Italy will not be able to keep its promise of 2.04%. The European Commission has cut growth forecasts for Italy to 0.1% from the original 1.2% it predicted in November. Massale found in a recent interview that if Italy's growth is 1 percentage point lower than an estimate, the country would take in 18 billion euros less in tax revenue.
Low confidence levels and political unrest have been driving these growth projections lower and yields on Italian government bonds higher, pushing up the cost of borrowing. The spread of Italian 10-year bonds over top-rated Germany widened to over 250 basis points, renewing concerns that Italy will breach EU regulations on the size of its budget deficit.
As you can see on this graph, Italy's unemployment rate rose to 10.7% in January and has remained above 10% for over 6 years. Youth unemployment in Italy, measuring job seekers from 15 to 24 years old, rose to and is currently at 32.8%, and recently climbed above Spain's for the first time in over a decade. In the Eurozone, only Greece has a higher youth unemployment rate than Italy.
Inflation in Italy held steady at 1.1% in March, up from 0.9% in January, but still significantly below the ECB target.
In broad strokes, we have painted a picture of a threatening Eurozone landscape and highlighted a precarious situation in Italy. Italy's in a bind, caught between slow economic growth and dangerously high debt.
Its debt is growing, but its economy is not.
Italy's economy is not growing and its population is collapsing. As a member of the common currency bloc, Italy cannot simply increase the money supply. In our opinion, the best way out of this economic malaise is through targeted, bold fiscal policy and related structural reform. So we now dig deeper into our challenge. What role does fiscal policy and legislation play in promoting economic growth?
Let's first address 2 primary drivers of Italy's dilemma. 1, insufficient capital expenditure, or CapEx, specifically regarding new technologies. And 2, brain drain, the emigration of potential talent from the country.
Issue number 1, insufficient CapEx. The big Italian economy is trapped in a small business model. Indeed, 95% of Italian companies employed fewer than 10 employees. The predominance of small businesses without a natural path to growth and expansion has precluded investment and competition. Italy's biggest startup, Music Max, is ranked 79th internationally, a poor representation for such a large industrialized nation. Furthermore, compared to other industrialized countries, Italy's technology platform is archaic. E-commerce growth in Italy has constantly lagged behind the rest of Europe and, as displayed, continues to slow year after year.
Issue number 2, brain drain. The alarming rate of youth immigration is a dangerous risk to the Italian job market, and as we've seen, Italy is also not replacing its own population. Many young Italians do not see or seek the benefits of Italian education, and their transition period from education to employment is inadequate. Worker protection laws make it hard to fire employees, which essentially pits older workers against younger workers. Young workers tend to get temporary contracts, while veteran company insiders tend to get more secure and long-term deals. So when companies need to shave costs, they fire younger employees. Because new jobs are so hard to find, nearly 50,000 young Italians left Italy last year, and 43% of young people plan on doing so in the future.
Earlier this week, we connected with a school in Italy to get a first-hand account of the current situation. We talked with high school students who confirmed that the current outlook for Italian youth is indeed distressing and that transformation is critical.
Fiscal policy and structural reform can be an effective way to stimulate the economy, but Italy's policies have been counterproductive for too long. Piling on more debt isn't the answer. It hasn't worked. The government needs to find and use creative, bold tools to stimulate the economy.
Specifically, we propose 4 policy solutions. First, enact a massive Italian deregulation program. Second, reform the education system. Third, lower corporate taxes. And fourth, lower personal income taxes just for the youth. Specifically in regards to deregulation, stripping out cumbersome and unnecessary laws, such as laws restricting mergers and acquisitions, can build confidence, promote growth, and increase foreign business competition, all without increasing the deficit. The European market for Internet of Things, IoT, is growing, and Italy needs to aggressively embrace opportunities that lie in consumer and business IoT. Fiscal policymakers can lower barriers and attract skilled specialists, particularly in the health and finance sectors.
Second, reform the education system. Italy's dropout rate is extremely high, particularly in the southern regions, where it can be as high as 20%, more than double the EU average. Tax revenues must be diverted from a cradle-to-grave welfare system to professional training, vocational schools, and higher education appeal. Italy needs to establish a legal and social framework to encourage young people to finish high school, contribute to an effective labor force, and boost productivity. The government must align incentives so that the Italians see the benefits of learning and working.
Third, lower corporate taxes so that businesses have money to invest in expansion. If businesses cannot generate enough profit to provide healthy returns to their shareholders, shareholders will pull money and move it to faster growing economies. The aggregate corporate tax rate is currently 27.9%. We propose to reduce this rate to 24% in order to entice foreign capital and allow businesses to invest in themselves.
Fourth, cut personal income taxes just for the youth. We want to target workers aged 18 to 25 with an incentive to work and contribute to the labor force of Italy, with a special 3-year rates of 10%, less than half the current tax rate. We do not favor plans that simply throw money at the unemployed. Social welfare spending for Italy for 2018 was 28% of the GDP, the 5th highest in the world. Our proposal rewards young Italians for hard work and creates a more productive Italy. We want to reduce youth unemployment to 20% over a 3-year period, matching pre-crisis levels.
Implementing these policy proposals will not be easy. We acknowledge that stimulative fiscal policy may increase debt in the short term, but the long-term gain is clear and critically necessary.
For too long, Italy has been trapped in a negative feedback loop of more spending, more borrowing, an aging population, and no growth. Per capita income in Italy is the same today as it was in 1999. It's time for structural reform. Our proposals open up Italian markets to the future and inspire confidence, hurtling Italy into a positive feedback loop, attracting young talent and capital, expanding business in the tax base, and creating a better future, not just for Italy, but for the Eurozone as a whole. Thank you.
Thank you very much for the presentation. So we have a number of questions, and Sheria, will you?
Sure. I'll start off with the anchor questions. So thank you also for this presentation. So the 7.8% euro area unemployment rate hides low rates in some countries and high rates in others. What can the euro area policymakers do to reduce the gap between countries with high and low rates?
Well, currently at this point, only 4 nations are actually above this average, and that's Greece, Spain, Italy, and France. And these are all countries that are suffering with current problems right now, with France, with the protests of Gilets jaunes, or the Yellow Vests, every Saturday protesting. Italy is having clear problems, as we have told you. All these countries need to do things to help benefit their country, all with inspiring confidence and getting people to move there, but basically increasing productivity and giving it a productive workforce.
And the largest reason for these high amounts of unemployment in these particularly 4 countries is that there's low job opportunity and low confidence in these jobs. So throughout the Eurozone, when we grow the economy, we'd offer more jobs and the economy would be able to sustain more jobs, thus lowering the unemployment rate in those countries and in the other countries in the Eurozone.
So the range of unemployment rates in the Eurozone is actually quite astounding. You have countries like Germany and the Netherlands on the bottom side. Germany has a 3.1% unemployment rate, whereas you see countries like Greece have 18.6%. And that's a very, very big disparity. And we can definitely have like fiscal boosts to productivity, but as a whole, there's a fundamental problem which in relation to how the ECB can approach these growth issues, and that's that when you have a single monetary policy for all 19 countries, there's no way you can adapt a policy to be efficient and help all 19. And that's an issue that we always are going to have to address, but that's an issue we can work around with individual fiscal policy.
Moreover, Italy can reform and fix their education program, having them learn more about jobs that they're more aligned with.
Thank you. The second question is, if the euro area enters another recession, while interest rates are still close to or below zero, how should policymakers respond?
So yeah, that's a very big risk that we see across the Eurozone because if we head back into recession, you can't stimulate the economy again by lowering interest rates since they're already so low. But what you can do is target fiscal policy in each of these individual countries, like we're doing in Italy. More specifically, towards Italy, what we can do is lower the corporate tax rates in order to encourage bigger businesses that employ more people. And also, one of the main problems in Italy and across the Eurozone is a low population. And so by stripping away certain taxes for the youth, we can encourage more people to stay in these countries.
Yeah, and generally, what's happening right now is that the ECB is trying to keep really low rates because a lot of these countries like Italy and Greece are struggling, needs to find some way to grow. But the problem is really simple. If you hit a recession, you can't drop them all the way down. So it's a real risk of using low interest rates. So that's when you have to turn to fiscal policy to try to find a way for these countries to escape a recession.
So the issue is, like, obviously the ECB wants to raise rates, but at the fundamental level right now, they're kind of caught in a bind. Because of the disparities between countries, they can't get away with raising rates. The US tried to raise rates too fast, and that got a lot of backlash from the market and also politically. So you have this issue that you can't raise rates that fast, but if you don't raise rates for a long time, there's a lot of negative harms, like the risk of a recession. And also, if you have low rates for a really long time, that lets fiscal policymakers run really high, it allows fiscal, it doesn't give accountability to those fiscal legislators to actually enact stimulatory policy, so they can rely on the central bank. Whereas if you let rates rise, you can have more accountability in the fiscal space.
Other questions?
So if I understand it, your proposal has an element of reform, but it has a big element of cutting taxes and increasing spending. So let me ask you a two-part question. One, how does that different than what the new Italian government tried to do last year that created the conflict with the partners in the EU and actually began to move us down the road of a mini crisis? Why is this, what you're suggesting, any different, and why would it turn out differently? And secondly, if the issues are intractable between Italy and its partners in terms of being able to use fiscal policy, should Italy consider actually leaving the monetary union?
Well, what we would say first is that we're not proposing to increase spending. We're proposing reallocations. We move money in education and move it towards better opportunities and less from spots that aren't as useful. We would say is that even though when you cut taxes and you make all these different proposals and changes, you're not going to see that much harm as long as we can kickstart the economy, which we will do, because we give these companies and all these other people the ability to reinvest in themselves, but also boost productivity. So many things will happen that will easily kickstart the economy, and these proposals will be successful.
So a lot of the social spending right now is means tested in terms of social spending and welfare based. But the issue is I think a lot of the strategy of the current Italian populist government is kind of throw money at the problem without actually creating real incentives. So lowering the corporate tax rates creates real incentives, and specifically when you lower the youth tax rate, that creates incentives for them to stay in the country. So it's different between just throwing money at the problem, but also addressing the root issue, which is there's not enough incentives or not enough confidence. And if you look at the broad scheme of things, the proposals that we have aren't that exacerbatory for the debt issue. So for example, cutting the corporate tax rate from 24% to 20% at the national level is only going to increase debt by a deficit by about $6 billion, which on the whole of things, when they're spending hundreds of billions of dollars, isn't that much of a reallocation. But what we're doing is we're reallocating inefficient spending to more efficient spending in terms of taxes and the like.
In the opening of your presentation, you mentioned Mario Draghi's famous whatever it takes statement. And you said that more recently, the ECB had also injected, I think this is your phrase, monetary drugs into the economy. Yeah. But can you give us some detail on the specific monetary policies that the ECB has pursued in recent years? Thanks.
Well, a lot what the monetary policy is doing is they've been focusing on not trying to stabilize Italy's borrowing cost, and a lot was that Italy's populist government is trying to try to put more money in towards the problem and throwing more money at it. But what we're trying to hope for is to put less money into the problem and more reform the money and use it in a smarter way.
Another part of what the ECB is doing for Italy currently is keeping interest rates very low. I addressed that in the new deal that they launched last month. They're keeping interest rates low for struggling economies like Italy and Greece. However, they're also buying these bonds, corporate and government bonds, in order to keep the supply of money into Italy strong in order to stoke some kind of economic growth.
So for the past bit of time, they've been buying $2.3 trillion worth of bonds. And the idea is they wanted to kind of ease away from that. They wanted to raise rates, but they couldn't do that because of the slow economic growth at the time. So their new goal is to kind of continue to purchase these bonds, but not buy more. And also, they're going to at least keep rates low until the end of 2019.
Maybe a follow-up to this question. I mean, the ECB sets its monetary policy not on the basis of the situation of particular country, but of the euro area as a whole. So if the interest rates are so low and unconventional monetary policy is carried out, is because inflation is very low. And, but doesn't necessarily mean that it targets the particular countries in the euro area. So you seem pretty critical of the monetary policy of the ECB. What should have it done differently?
We're not super critical per se. We're just sympathetic with the limited amounts of things they can do, given the current situation, which is really a bind between all countries. It'd be hard to move in any one direction. But I think that if inflation picks up, they should definitely pursue their policy of raising rates so we can have it higher for the next recession. But until then, I think having low rates is important and stimulating growth for these nations like Italy, France, Spain, Greece. So it's really tough for the ECB to definitely pursue a policy given the disparities between countries.
Yeah. Having low rates makes it really easy for loans cheap so you can start businesses, but then also if you make less money from saving, so you're always going to want to invest money into the economy. So if we have this incentive with low rates, we're always going to see the bigger possibility of doing this, but then when you raise rates, people right now are just going to want to keep money in the bank and let them accumulate interest, which is not good for Italy's economy, Spain's, France, all these different countries that are suffering right now from low growth.
Right now, we're the most critical of the inflation rates in Italy because they are, throughout the start of 2019, seeing some positive aspects of their economy coming back. Like employment is rising and wages are going up, but the inflation number is staying the same or even dropping. So it represents how unconfident people are in Italy's economy, and that is what we're most critical of, and we think that economic growth will help that the most.
More specifically to the ECB, we agree that what they're doing is incredibly helpful. If they are not doing it, there's no other way out. But we're also putting some of the blame on Italy and their own policies. The ECB is basically doing all it can, but if there's nothing much else that we can do, so that's why we're turning to Italy in order to reform.
Okay, we have now run out of time, so thanks a lot.
Thank you.
For your presentation.
Thank you.